benefits of the real-time service, plus all access to the historical tools. Okay, let's see here. Okay, we're getting close to the end, and I just had a really good question. I don't know if I have full time to answer. We just received a question from Mo. Can you clarify as how these stocks and their options vary when stock goes up or down in value? Well, there's two functions of that, and let me go back to the Power Options tools real quick here, and we'll just try. Let me go to the option chain for standard stock. I'll use Apache. Pretty sure it took a big hit today like everything else. Hey, down $3. How about that? But what I'm going to do here is I'm just going to take an example, okay? And here we're looking at the money 95 call for Apache. The current bid price is $295. The ask price is about $310. Right? So that's the current price for the Apache position. All right? Now this is an out-of-the-money option, Mo. We're above the current stock price. The stock price is at $94.12. We're looking at the 95 call, so it's about 80 cents, 88 cents out of the money. So this premium, if I went to sell this call, I'd expect to get maybe $295. If I was going to buy this call speculating, I'd expect to pay around $310. That's the bid and the ask price. This is important right now. The implied volatility is about 0.37. I want to keep that in mind. Okay, 0.37. Okay? And out-of-the-money options, options that are above the strike price, call options. Ooh, I almost caught myself in that trick, didn't I? Call options that are above the strike price, 95, 100, 105, 110. These are all out-of-the-money options. So this premium is called time value. We'd be collecting on the value of the time until the option expires, or we'd have to be paying for the right to buy the stock until the option expires. Now, as we go deeper in the money, we go below the current stock price. Let's just take the 90 call, for example. We have a bid price of $580. Okay, so it looks pretty expensive, but the stock's currently trading at $94.12. If I buy the 90 call, that means I'm $4.12 in the money. Okay, I have $4.12 of intrinsic value. I'm buying the right to buy someone's shares of stock at $90, even though it's trading at $94.12. So $4.12 of that $580 premium, or let's just take the $6. The $6 premium there, that's intrinsic value. The remaining value there, the $1.88. Okay, so we have $4 of intrinsic value. Let's take the $6 here. We have $4.12 of intrinsic value and $1.88 of time premium. Okay? And as we can see, the time premium, what's called the time premium, is always highest when we're at the money. Okay? Now, I just wanted to point that out because as we go deeper in the money, we have higher intrinsic value but lower time premium. At the money has the highest time premium of all options. Not the highest price, but the highest time premium. And the out-of-the-money options are just time premium. Okay? But how is this going to react when the stock increases? Well, what I'm going to do is go to what's called the Black-Scholes Calculator. This is the theoretical pricing model of what we expect to happen, okay, if the stock changes in price. So what we're shown here, the Black-Scholes pricing model takes into account 5 factors: the stock price, the strike price of the option, the days remaining to expiration, the volatility of the stock, and in this case we're using the SIV, the Stocks Implied Volatility Index, the current interest rates on the market, and the percent dividend yield. Those 5 factors are plugged into an equation which gives us the theoretical worth of where the option should be priced. Okay? Now, looking at an option, those 5 factors, stock price, strike price, days to expiration, volatility, the yield, and the interest, what are the only 2 things that can change? Well, the only 2 things that can change as the stock moves up or down are the stock price, okay? Stock price, strike price is always going to remain the same. Days to expiration, well, it depends on what day we're on. That's always going to be the same. It always expires in November. And the implied volatility, the interest rates there and the yield don't tend to change too much, okay? So what we want to know is, well, what's going to happen to this call? Remember, that call was originally priced at $295 bid and a $310 ask. It's kind of shown down here. The theoretical value actually is about $306. Okay, so for the call, I'm going to go ahead and assume what happens if the stock moves up to $99. And I'm going to click Use these hypothetical numbers, okay? So just focusing on the call. This broke down the call and the put for me, the put bid and the call bid. But if the stock went up to $99 for the call, our 95 strike call, we'd expect to have a bid of $593, okay, or a time value of about 32.6%. Okay, so the stock moves up 5 points from where it is right now. We'd expect our 95 call to move from about 295 up to 593. And then, of course, it shows me going down the line, what would this call be if the stock was trading at $99 per share on 11/11? Well, that's what we'd expect to see. This is the theoretical pricing model. What happens if the stock drops down to 90? Where would our 95 call be then? Let's go ahead and click Use these hypothetical numbers. Okay? So naturally, as the stock drops, our call option is going to decrease in price. Remember, call option increase in price when the stock moves up. It decreases when the stock moves down. So if the stock fell to $90, let's say on Monday, for example, or Monday the 2nd, we'd expect to see a bid of $1.36. We drop from $2.95 to $1.36. Again, this is just the theoretical pricing model of what the option would look like based on those 5 factors. Now, the trick is, Mo, if you haven't gone through some independent study on options, you may not, I'm not sure how familiar you are with options there, but something can happen. If the stock takes a big hit, and if the market takes a big hit as we saw today, the implied volatility is going to adjust as well. So it's possible with the stock dropping down to 90, dropping 5 points in the next day, the implied volatility might go up a couple of points too. Implied volatility is a measure of risk. So let's say the implied volatility goes up to 0.42 and the stock drops to 90. We click Use these hypothetical numbers. Now we see on Monday the option would be worth 165. Well, why is it worth more? Because that change in the implied volatility, the change in the fear measure, actually inflates the premium. They become more risky, so the premium gets inflated. Not inflated over the original price, but just inflated over what the stock, the theoretical price would be if the option had dropped to 90 and the implied volatility changed the same. Okay? So as the stocks move up, it's kind of hard to really answer that question of how they're going to vary. The answer is it depends on the severity of the move on the stock, any shifts in implied volatility, and how far in or out of the money you started and what direction the stock moved. Of course, also going to depend if you're in a call or a put. If the stock moves down quickly, your put's going to be very profitable. Your call is going to lose a lot of money, which may benefit you if you're short a call, because then you can buy it back on the cheap. But if you're long the call, you're going to lose a lot of premium in the case of a market decline like today. Mo, if you need any further clarification on that or you want to discuss it further, please just send me an email. Let me flip back over here to my last little slide. Second to last little slide, I apologize. Upcoming webinar events. Tuesday, November 3rd, 12 p.m. Eastern, we do the Introduction to Radioactive Trading Methodology. Myself and Kurt Frankenberg. Really, it's Kurt Frankenberg. I'm just there to show some of the power options tools with him. Tuesday, 9 p.m. Eastern, we're going to host the Power Options for Radioactive Trading. I'll walk through, spend about an hour walking through the tools on Power Options and how you can use them for the radioactive trading method. Wednesday, November 4th, 12 p.m. Eastern, we're going to do an hour presentation on using the search tools on Power Options. We're probably only going to focus on one strategy there. Might be covered calls, might be long calls, it all depends. Thursday, November 5th, 12 p.m. Eastern, another Introduction to Radioactive Trading presentation. You can get more insight into the radioactive trading methodology. And most likely at Thursday, November 5th at 6 p.m., I'll be hosting the Introduction to Iron Condor presentation. And then again, Friday, November 6th again, 4:15, 4:30 Eastern Time, we'll do another open discussion. Mo, this is the slide I wanted to show you. If you have questions, feel free to contact us at any time. You can email me to support@powerop.com. You can call us toll-free during market hours, 877-992-7971 if you live inside the continental U.S. Or if you're international, you can call us at 302-992-7971, and there's also contact links on every page. So, Mo, if you wanted to send me an email if you had further questions about what we just showed with the Black-Scholes pricing model or questions about the implied volatility, go ahead and send them our way. All right? Well, we don't have any more questions. We're a little bit past our time. Ladies and gentlemen, I thank you for joining me this evening. I hope you all have a happy Halloween weekend and you enjoy the festivals and the spirit of the season, I should say, for lack of a better term. Take care, everyone. I hope to see you next week at one of our other free webinars. Happy trading. Good night now. Bye-bye.